When you see a massive lightning strike illuminating the entire sky, there is always that eerie kind of silent pause before the thunder actually hits your ears.
Oh, yeah, definitely
You were
my
just
tip.
standing there, bracing for the impact, knowing the event itself is already over, but your experience of it is completely warped by the delay.
Right, because the visual happens instantly, but the sound waves, they literally have to drag themselves across the distance to reach you.
Exactly. And we are looking at a financial lightning strike today. Today is Monday, July 20, 2026, and we're talking about a massive multi-billion-dollar event that actually happened back in March.
Yeah, months ago.
But the thunderclap just shattered the stock market this morning. So we are pulling apart a really interesting stack of sources today to help you understand this real-time collision between incredibly dense legal theory and, well, explosive stock market action.
Yeah, we are working with a fascinating mix of materials to decode this one. The foundation is this highly technical legal text by the law firm Proskauer. It's titled A Practical Guide to the Regulation of Hedge Fund Trading Activities.
Real page-turner, I'm sure.
Oh, absolutely. But we are crossing that dense text with breaking financial news from Big O Finance and T&W, actual SEC filings that dropped literally today, and the live, real-time reactions of retail investors scraping this data on Reddit and StockTwits.
Right. So our mission for this deep dive is to decode the hidden mechanics of institutional trading rules. We want to reveal how an incredibly obscure SEC filing rule created a sudden market frenzy today around an AI cloud startup called Nebius Group.
Yeah, that's the goal.
We want to give you a Wall Street insider's lens so that you never misinterpret delayed financial news again. And, well, here's where it gets really interesting. Today's big market-moving news, the massive surge in trading volume that has everybody talking, was actually set in motion months ago by lawyers writing contracts.
Right, and to see the wires pulling the market, we have to open up that Proskauer guide. I mean, it serves as a regulatory playbook for hedge funds navigating federal securities laws, specifically focusing on Sections 13D and 16 of the Exchange Act.
Okay, so what did those sections actually do?
Well, these are the thresholds that dictate exactly when a major investor has to reveal themselves to the public.
So 5% is the first invisible line in the sand. Okay.
Exactly. Under Section 13, the moment an investor acquires a 5% beneficial ownership stake in a public company, the clock starts ticking.
Right.
They are legally obligated to tell the world, and the SEC provides two different forms for this, depending on the investor's intent. So if you are just parking your money, meaning you have no intention of changing the company's strategy or trying to influence the board of directors, you file a Schedule 13G.
Okay, but if you want to shake things up,
Yeah.
you file a Schedule 13D. Right. I mean, the 13D requires you to publicly detail your master plan, your proposals, and basically how you intend to alter the company's trajectory.
Yeah, and funds desperately want to avoid tipping their hand to competitors or management before they are ready.
Makes sense.
But the 5% threshold is just a warning label compared to Section 16, which triggers at 10% ownership.
Oh, wow.
Yeah, crossing 10% subjects you to strict short swing profit disgorgement rules under Section 16B.
Wait, short swing profit disgorgement. Now, break that down for me. If I own 10% of a company, what exactly happens to my money?
So if you hit that 10% mark, you are classified as a corporate insider. From that moment on, if you buy and then sell the company stock within any 6-month window and you make a profit, the law says you cannot keep that money.
Seriously, you just lose the profit.
You have to disgorge it, meaning you legally must hand your trading profits directly back to the company you invested in.
Wow.
It is a draconian rule designed back in the 1930s to prevent insiders from making quick cash grabs based on non-public information.
Okay, I imagine if you start creeping up to 10%, the SEC doesn't just want a form filled out. They want blood. So a 13G at 5% is basically registering as a tourist.
Yeah, exactly.
You are just visiting, keeping a low profile. A 13D is applying for a demolition permit. But crossing that 10% line means the museum guards are, like, emptying your pockets at the door to make sure you didn't steal the artifacts.
That's a great way to put it. And the enforcement mechanism for that 10% rule is entirely outsourced to the public.
Really? How so?
There is a whole cottage industry of plaintiffs and specialized lawyers who do literally nothing but monitor SEC filings. They set up alerts waiting for a fund to accidentally cross that 10% line and execute a trade within 6 months.
You're kidding?
No. And when they spot a violation, they sue the fund on behalf of the company, and they get a cut of whatever money the fund is forced to return.
Wow, so with bounty hunters constantly watching, Funds must spend a fortune on legal engineering just to avoid crossing those tripwires in the first place. The Proskauer guide talks about contractual blockers. How does a piece of paper override the reality of how much stock you actually own?
Well, a contractual blocker is a clause embedded right into the DNA of the investment agreement itself. Imagine a fund wants to buy warrants, which give them the right to purchase millions of shares in the future.
Okay, sure.
They will write a blocker into the contract that explicitly revokes their own legal ability to exercise those warrants if doing so would push their ownership past 4.99% or 9.99%.
Oh, I see.
And the SEC looks at that and agrees. Because the contract physically prevents you from taking the shares, you do not technically own them for regulatory purposes.
So it is essentially a self-imposed speed limit. You are buying a Ferrari, but having the dealer put a governor on the engine so it physically cannot go over 65 miles per hour just to avoid getting a ticket.
Exactly.
Then there is the rule of threes for board blockers. The sources mention this is about diluting control. What's that about?
So, beneficial ownership in the eyes of the SEC is not just about whose name is on the bank account. It is about who has the voting power to make decisions.
Right.
If a fund is managed by a board, some lawyers use the rule of threes to sidestep the filing requirements. The argument is that if ultimate investment control is shared equally by 3 or more individuals on a board, no single person has beneficial ownership.
Because no single human can authorize a trade without convincing at least one other person.
Exactly.
You just spread the responsibility out so thin that it evaporates. No single person has to put their name on a Schedule 13D.
Yep.
But, okay, if Wall Street is spending millions on lawyers to build these blockers and avoid the tripwires, why do we see these massive filings hitting the newswire constantly? They clearly cross the line eventually.
Well, crossing the tripwire is rarely an active decision made on, a Tuesday morning.
Yeah.
The legal structures are designed with mechanical countdowns embedded inside the securities.
A countdown.
Yeah, the fund buys an instrument, puts it in a vault, and a clock starts ticking. When that clock hits 0, the tripwire is triggered automatically, regardless of what the fund manager is actually doing that day.
Okay, so we're talking about the 60-day rule now.
Right. Beneficial ownership gets incredibly complex when we introduce derivatives into the mix. Cash-settled derivatives usually avoid the 5% or 10% thresholds.
Because there's no actual stock trading hands.
Exactly. If you buy a cash-settled swap, you are just making a financial bet on the price of the stock going up or down. You don't get voting rights, and you can't influence the board, so the SEC is less concerned.
But a stock-settled derivative is a completely different animal.
Totally different. Stock-settled instruments, like options or warrants, eventually turn into real shares with real voting power. The SEC's rule states that if you hold the legal right to acquire the underlying stock within the next 60 days, you are deemed the beneficial owner of those shares right this second.
Okay, I need to wrap my head around the instrument itself before we look at the timeline. The sources talk about Nvidia holding pre-funded warrants in Nebius. What exactly is a pre-funded warrant in plain English?
Think of it like a fully paid layaway or a rain check. A standard warrant gives you the right to buy stock at a specific price later. Say you pay $1 today for the right to buy a share for $10 next year.
Right.
But a pre-funded warrant means you paid the entire $10 up front. You have already handed over the cash. The only thing you are holding is a piece of paper that says you can demand the actual shares whenever you want.
So it's like, I have paid for the groceries, they are bagged up at the register, but I just haven't walked out to my car with them yet.
Exactly.
Let's map this onto the breaking news that just blew up the market today. The headline flashing everywhere is that Nvidia filed a 13G, revealing a 9.3% stake in the AI cloud company Nebius. That is 22.25 million shares.
Yeah, and looking at a headline like that, the immediate assumption is that Nvidia just aggressively bought up nearly a tenth of a company on the open market, like today.
Right, but when you actually read the SEC document instead of just the headline, only 1.19 million of those shares are held directly. The vast majority, 21.07 million shares, are sitting in those pre-funded warrants. And Nvidia acquired those warrants on March 11, 2026 as part of a $2 billion funding round.
And those specific warrants for March came with a rigid lockup period attached to them. Nvidia is legally barred from exercising the warrants, meaning they cannot take possession of the shares or sell them until September 11th, 2026.
Okay, let's unpack this. If Nvidia paid for these warrants in March, and the contract physically locks them in a vault where they cannot be touched, exercised, or sold until September 11, why on earth is the SEC forcing them to file a document declaring they own the stock in July? Doesn't reporting a future ability to own stock just severely confuse the public into thinking a massive trade happened today?
Well, the SEC's perspective is entirely focused on early warning systems. The 60-day window was established to prevent shadow takeovers.
takeovers.
Yeah, historically, rogue investors would secretly stockpile warrants or options, then exercise them all at once on a Friday afternoon, suddenly seizing control of a company before the board or the public knew what was happening.
Oh, I see.
So by forcing disclosure 60 days before the right to acquire the stock becomes active, the SEC ensures the market gets a 2-month heads up about who is about to wield significant voting power.
Okay, so let's do the math on the calendar. The lockup expires on September 11th.
Right. Take September 11, grab a calendar, and count backward exactly 60 days.
You land squarely on July 13th.
Exactly.
So the countdown hits 0. On July 13th, simply because the Earth rotated enough times, Nvidia legally became the beneficial owner of 21 million shares under the SEC's definition. That tripped the 5% threshold. They had a few days to file the paperwork, and the 13G hit the SEC database today, July 20.
What's fascinating here is the collision between this analog regulatory clock and modern market infrastructure.
Oh, absolutely.
Because the moment that 13G hit the SEC database, algorithmic news scrapers pulled the data. They scanned for the keywords: Nvidia, Nebius, and 9.3% stake. The algorithms don't read the footnotes about March 11 or pre-funded warrants. They just execute buy orders based on the perceived catalyst.
And the market reaction was violent. Nebius stock ticker symbol NBIS shot up almost 4% in after-hours trading. Over on StockTwits, sentiment immediately registered as extremely bullish, with message volume exploding by 150%.
Right. The retail trading community instantly constructed a whole narrative to explain the price action, completely divorced from the regulatory reality of the 60-day rule.
It's wild. I was reading through the r/NBIS_stock Reddit thread as this was unfolding.
Yeah.
You have users shouting, "Jensen bought the dip," referencing Nvidia's CEO, Jensen Huang.
Okay.
People were attributing the 4% spike to the Jensen effect. One highly upvoted comment literally said, "While retail doomer panic sells, Jensen buys your cheap shares." They genuinely believed Nvidia executives were sitting at trading terminals today aggressively buying up Nebius stock to support the price.
Yeah, they observed the thunder and just assumed the lightning was happening right above their heads.
And there was one single user trying to stop the train. Someone commented, "The news does not mean much. These were pre-funded warrants purchased on March 11. They can't sell these until 9/11/26. But that comment was buried at the bottom of the thread. The hype completely drowned out the truth.
This raises a really important question about market efficiency and truth. I mean, we have algorithmic scrapers triggering automated buys, which creates real upward price momentum.
Right.
That momentum triggers retail fear of missing out, or FOMO.
Yeah.
Suddenly you have millions of dollars changing hands and real market capitalization being generated out of thin air, all because a mechanical countdown timer forced a lawyer to submit a PDF.
Yeah. So does the fundamental reality of why the filing happened even matter if the collective misinterpretation still drives the stock price up and makes people money? Is the illusion just as good as the truth if it works?
Well, momentum can sustain itself for days or weeks on pure sentiment, but fundamentals are gravity. If retail traders buy in at elevated prices because they falsely believe Nvidia is injecting fresh capital into Nebius today, they are going to be left holding the bag when they realize no new money actually entered the system.
That makes sense.
The price will eventually revert to reflect the actual capitalization of the company.
But we shouldn't dismiss the investment entirely just because the filing was delayed.
Right.
$2 billion is a staggering amount of capital, even if the check cleared back in March. Nvidia made a massive bet here.
Absolutely. We have to look past the paperwork glitch and examine the asset itself. I mean, why did Nvidia choose to park $2 billion into Nebius Group?
Well, according to the reports from Big Finance, Nebius has an incredibly unique origin story. They're currently an Amsterdam-based AI cloud company, but they were originally born out of Yandex, which is often referred to as the Russian Google.
Right.
Following the invasion of Ukraine, the company spent 2 grueling years restructuring its assets. They eventually sold off the Russian business entirely, severed those ties, and took the international AI-focused assets to form the foundation of Nebius.
And they took that foundation and immediately pivoted to building massive physical AI infrastructure. They are not acting as a software middleman. They are literally pouring concrete and building gigawatt-scale data centers specifically designed for artificial intelligence compute.
The scale in these reports is just difficult to comprehend. They're constructing a 1.2 gigawatt AI factory in Missouri. 1.2 gigawatts is roughly the amount of electricity required to power hundreds of thousands of residential homes, and Nebius is funneling all of it into server racks.
Wow.
And their stated goal is to reach 5 gigawatts of capacity by 2030.
Yeah, sourcing the power and cooling for 5 gigawatts is a monumental logistical challenge, but financing the hardware to fill those data centers requires a balance sheet most startups simply do not have. The TNW report highlights that Nebius just announced a $775 million debt raise.
Right.
The structure of that loan is deeply telling. It is secured by their deployed GPU infrastructure and backed by contracted cash flows from a major investment-grade customer.
Wait, they are literally using the Nvidia chips themselves as the collateral for the loan to buy more chips.
Yes.
And Wall Street is buying into this aggressively. Analysts at Freedom Capital just upgraded Nebius to a buy with a $200 price target. Northline Capital Markets pushed their target all the way to $410. Based on the trading price when these reports were issued, Northland is projecting a 124.5% upside.
Northland's valuation model hinges on Nebius's position in the AI as a service sector. They are projecting Nebius could capture up to 14% market share among independent AI cloud providers.
That's huge.
It is. They highlight the company's asset-light operating model, where external partners finance the actual data center construction. That allows Nebius to focus its capital entirely on system architecture, GPU deployment, and software optimization.
Okay, I understand why Nebius needs Nvidia. You cannot build a 1.2 gigawatt AI factory without a mountain of top-tier GPUs. But why does Nvidia need Nebius? Nvidia is the most dominant hardware company on Earth right now. Customers are begging for their product. Why take $2 billion of your own cash and inject it into a startup cloud provider?
If we connect this to the bigger picture, NVIDIA is in the middle of a highly defensive strategic transition. They recognize the vulnerability in remaining just a hardware vendor. They are aggressively evolving into a strategic AI infrastructure partner to protect their moat.
Because the hyperscalers, Amazon, Google, Microsoft, they're tired of paying Nvidia's premium prices.
Exactly. And we saw the threat materialize on the exact same day the Nebius news dropped. A separate headline announced that AMD's Helios systems were officially adopted by Microsoft Azure.
Oh, wow.
The largest cloud providers in the world are actively diversifying their hardware to lower costs and reduce their dependency on Nvidia.
Got it. So by pouring billions into specialized neocloud operators like Nebius and CoreWeave, Nvidia is buying loyalty. They are ensuring that the next generation of massive AI data centers is completely optimized for Nvidia hardware and deeply integrated into the CUDA software ecosystem.
Exactly. And once developers build their AI models on CUDA, transitioning those models to run on AMD chips is incredibly painful.
So what does this all mean? It sounds like Nvidia isn't just selling the picks and shovels for the AI gold rush anymore because other people are starting to manufacture cheaper shovels.
Right.
Instead, they are taking equity in the new mines, they are funding the miners directly, and they are locking them into ironclad contracts that ensure those miners are only physically capable of using Nvidia brand shovels. They are acting as the arms dealer, the bank, and the landlord all at once.
That's spot on. They are utilizing their massive capital advantage to architect the future supply chain of global compute, guaranteeing that they remain the bottleneck for the entire industry.
Taking this deep dive through the legal tripwires, the 60-day rule, and the fundamental strategy behind the headlines equips you with a new analytical tool. You have a superpower now.
Yeah, you no longer have to rely on algorithmic alerts or Reddit sentiment to understand market movements.
Exactly. The next time you see a breathless notification that a major tech giant just took a 9% stake in an emerging company, not to just hit the buy button.
Right.
Pull the actual SEC filing. You check the dates on the pre-funded warrants. You do the 60-day countdown math. You look for the origin of the thunderclap instead of reacting blindly to the noise.
But, the Proskauer Guide contains one final, heavily guarded concept that we need to address before we close. It paints a picture of how these legal mechanics could be used on a much more massive, coordinated scale.
Really? What is hidden in the fine print?
So, the SEC rules dedicate significant space to the concept of forming a group. If two or more funds or tech giants reach an informal agreement to act together for the purpose of acquiring, holding, or disposing of equity, the SEC immediately aggregates all of their shares together.
Okay, meaning what?
If Fund A owns 3% and Fund B owns 3%, the moment they agree to coordinate, they hold 6% as a group and instantly trigger the 13D filing requirement.
Ah, so they crossed the 5% tripwire together, even if neither of them crossed it alone.
Exactly. And we just spent this deep dive proving that mechanical rules like the 60-day window on pre-funded warrants can legally hide a $2 billion stake from the public for months.
Right.
And the Proskauer text outlines the precise legal boundaries of how funds can hold discussions without legally crossing the threshold of becoming a group.
Oh, I see the pieces coming together.
If the regulations intentionally allow investors to delay public visibility for months using contractual blockers and forward-dated warrants, and highly sophisticated legal teams know exactly how to coordinate strategies right up to the very edge of the group definition, could the major tech players and hedge funds be quietly coordinating vast control over the world's emerging AI infrastructure completely in the dark?
Are they laying down a massive invisible web of pre-funded warrants across every major AI startup, carefully managing their thresholds, and only tripping the regulatory wires when the board is completely locked up and it is entirely too late for the rest of the market to react?
It is a question of whether the filings we see today are just the delayed thunder of decisions made a long time ago.
We are all staring at the stock tickers, completely oblivious to the fact that the lightning struck months ago, and the landscape of the AI industry has already been permanently altered. Wow. Thank you for joining us on this deep dive. Keep reading the fine print, watch out for the 60-day rule, and we will see you next time.